You're here for show 5 for our Moomoo Investment Outlook for 2024. We had you previously at 3 p.m. Thank you for joining us. Now you're for part 2 of day 3 with us. I'm your host, Olivia Higgins. Now today is going to be great because this is a final show for our series, but also we've got an exciting topic for you. If you want to find out what it's about, you've got to stay until after this video as we wait for a few more people to join us. Enjoy. Welcome back, everyone. You're with me, Olivia Higgins, and you're here for day 3 of our Moomoo Investment Outlook for 2024. We had you before, and now you're here for our second show of the day. Now, are we truly at a turning point? We're going to find out from our expert today. But before we begin, again, do not take anything as financial advice or recommendations. Today is about networking and engaging with us. I'm always really looking at your comments and also everything that you want to know from the particular shows. So I'll be watching the chat box right there. If you're ready for this show, I would love to see a thumbs up or a heart. Send me your emoticons and I will pay attention to that to show your support for the live shows. And going forward, we know that this is our chance to really network with you and also be the bridge to experts like today. So today, are we truly at a turning point? We're going to find out. Today is all about investing in 2024, and we're going to cover a various range of topics, but really it's about maximizing your returns this time in a volatile market and explore what that means for yourself as an investor on here with regards to the current investment landscape. I mean, we're talking about uncertainty, volatility, a lot of things going on right now on a macro scale. But today we're going to find out how you can maximize your returns within this space. So let's invite back onto the show from CSOP Asset Management, Head of Quantitative Investment, Yiwang, everyone. Welcome back, Yiwang.
Hi, hello.
Hi, how are you doing today? Thank you for coming onto the show. Now, for those of the audience members that don't know you, tell us about yourself and also the objective of today. We're talking about whether we're really at a turning point at the moment.
Yeah, sure. My name is Yi, and I'm head of quantitative investment team within CSOP. And CSOP is an ETF house based in Hong Kong, and we have a lot of products being listed on Hong Kong Stock Exchange and also Singapore Stock Exchange as well. So basically, the product covers equity, fixed income, money market, and leveraging risk bonds. So pretty wide spectrum of offerings. So today's topic, I think, is a very hot topic right now. All the markets are talk about like the turning points and the stage of the Fed Reserve hiking, and when is that kind of coming for the first cut, and what's the expectation for next year. So probably take the chance, we will share our views with you guys, and also go through our logics. Hopefully that's gonna helpful for your next year investment. Even there's 1 month left.
Exactly. I mean, to be precise, it's only 4 weeks left to the end of the year. I cannot believe it. We had such a great year of highs and lows. Now we're going to really go into the emerging markets for the first topic of today. Now, what's your view and insights on emerging market stocks amid the high for longer interest rate environment, Yiwang?
Yeah, I think that's recently has been quieting down significantly for long end U.S. Treasury yields, which looks particularly scary during from August to October, I think. And that's the main reason being is the Treasury Department start to issuing dramatic amounts of debt on the market. Is much higher than the say the market expectation, because they build up the market expectation in March, April during the SBB events, but afterwards, when we see that the final number in August, then we start to see, okay, you're going to issue more, and you ask the market to provide more liquidities. And what happens to the market for the longer end, especially for the 20-year or 30-year, the auctions start to have stress and some failure of the auctions. So that's the main reason why we have the correction happening. So if you look at the, we can show the slides, say the first page, say page 4. So that's the expectation for the rate cuts. But actually, the recent events, what happens is not regarding the Fed Reserve movement. Is regarding the issuing of the issuing size of the Treasury Department. However, the expectation is the expectation. This is based on the future market, so we can see that the market expecting the first rate cuts are probably coming early, like say next year Q2. Around that area. So because currently, I think for October, we have a quite good like CPI data has been shown on US market, reduced in line with the whole year trend. If you look back for the whole year, I would say Fed Reserve already did a quite good job, to be honest. So the inflation coming down significantly, and right now the core CPI, the rent, including the core goods, second-hand cars, and so forth. So they are all showing like a reducing pattern. So nothing particular. Like September, when you ask the same question, I'm gonna say, okay, the rent looks a little bit scary because they're ticking up again. But now, if you look at the rent, the house price, then everything seems quieting down, which is quite good, actually. If move on to next page, so even though the hiking rates, the rate hike, and but the U.S. economy remain very strong, to be honest, during the whole year. So I think that's the reason why the U.S. market is particularly performing during the year. Regardless, it's holding because of the 7 stocks. But overall, I think the index is bouncing up significantly compared with the rest of the world. If anything comparable, I think Japan market probably one of them. And for the hiking, a lot of people asking the questions, say when and what level they're expecting. I think the Federal Reserve normally coming to a level around the 3.3% or 2.5, this kind of level. So the current trend is towards that kind of level. If we see that kind of level has been achieved, then what happens is we can expecting the rate cuts and also say they are changing. They're going to change the hiking rates and to call it a day. I would say, but the tricky question right now, I think, is higher for longer arguments whether it's going to be sustainable. If you're thinking about if you are a Federal Reserve Chairman, then what your KPI is? Your KPI is inflation rate, and inflation rate control. Then if you announce that I'm gonna cut rate, which means my job is done, then you need to be very well prepared to testify when you face the Congress to say, okay, this has been achieved, this has been done, and probably for next page. So the baseline scenario right now, everybody talking about is soft landing, but I think probably even better than that, even no landing. So look, currently the job market seems to be quieting down now. So people start to talk about like US heading into recession next year and economic data. But to be fair, now it's just quieting down. It's not enter into like negative territory at all. So last month, people already still talking about overheated economy, but now we are talking about recessions are kind of coming, and that's all print on the long end like interest rate already. So I think the market now is too dramatic and would like to price in a lot of factors. So right now, I think given the October, they slowing down the issue from the Treasury Department. That's the reason why a lot of bonds, longer end bonds yield has been dropping down. But bear in mind, at the same time, the equity market rallied, but for this week is not moving in line with the bond. What does it mean is even the bond is shutting down in terms of yield, but the equity market is not rally further. So the correlations between the risky assets and the risk-free assets nowadays, especially for those 2 weeks, has been broken down. So I think that's kind of a risk factor because for next year, Q1, the Treasury Department will resume their original plan. The problem is they still need money, and they still need to spend money, and the spending is all is kind of a combination of like pensions, healthcare, and this kind of fixed cost. I can't say it's lawful cost, I would say, because they need to come up with a law and decide this is how much I'm going to spend next year. So as US government, it's not very easy to say, okay, I want to cut down this particular cost for now. So as a spending increase, what has been very strong for US economy, we would say is the residential side. If you move on to next page. So this is the assets combination. A lot of like during COVID and until now, I would say is government taking leverage within US, as we heard the story. So they print a lot of money and spend. It's not spending. It's helicopters spreading money, and all the residents have the money to spend, but don't need to work at work. Which is very good. I would say it's can be jealous. But yeah, the fact is, so they have the money, but is taking leverage from the government. On another side, the residential side, households, they are not taking too much leverage. And given this year very good performance of the equity market, and so their asset side increased quite a lot. So they have decent amounts of money to squander. So you see a very, very strong consumption data has been released for Black Friday and also recently. So for the summer holidays, services consumption remain very strong. So Because everything coming back for a reason. So they have money, and the stock market gave them enough money to squander, and also they didn't take too much leverage. Starting point of time now. And yeah, there's another side factor. The banks and financial institutions are tightening their criteria. So it's a little bit hard to apply for new mortgages, car loans, and so forth. So that's a side effect for the high interest rates right now. So that's the reason why we see the CPI is quieting down, because if I can't take loans, that which means I'm not buying new house, I'm not buying new cars, but I can still spend the money and taking consumption loans. Bear in mind, US is a consumption country, so 60 or 70% of GDP is attributed by the consumption, local consumption. So if they can remain strong, then which means they still have quite a bit like space to boost up their economy. To be honest, yeah. If you move to next page, please. Yeah, this is a liability I'm talking about. So even though they are taking more, so this is a very interesting question as well. We have been asked again and again. So a lot of people asking high interest rates. Mortgage rate we see in US is around 7%, or closing to 8%. Why they don't have particular burden? I would say they normally within US they can lock up the mortgages for 30 years. For example, and or 15 years or 20 years, these kind of things. So what does it mean is I saw statistics around 70% or 80% people, so they are still paying like 3% mortgages. So you can imagine now it's mortgages is a 7, but it's still paying 3, and you can still paying 3 for next 20 years. So which is quite bargain and quite good offering, right? So that's reflect on the housing market. Is a secondary house. No one actually want to sell it, because if you sell it, then you need to remortgage. Then if you remortgage, then you will enter into a 7% mortgage. So primary market is only in supply. That's the reason why I think currently, even with very high interest rate, very high mortgage rate, but the property market in US generally has been booming for the whole year, and also the rent. But now, once they tightening the criteria, then what we see is finally the property market has been quieting down a bit, and that attributing to the rent to the CPI. So that's what happened. But as a burden or as a liability for the households, I think it's manageable. But as time passing by, I think the impact will be stronger and stronger. But right now, if you project just for 1 year, I don't think that's going to be end of the world if the mortgage is shooting up to 7%, 8%, because most of the people, simply has nothing to do with them. Yeah. So probably move to next page, please. So this is a very interesting argument. So interest rate cuts, this is might not be good for enterprise. Currently, I think there's for previous several years, for no matter it's for S&P or Nasdaq, what people care about or value most, I think, is the dividend and share buyback scheme. So they issuing that and buying back the mortgages, buying back the shares. So what happens for the high interest rate environment? We saw that those kind of activities is slowing down, which is a little bit tricky. And for the S&P 500 versus like Federal Reserve rate ratio, this is just a technical thing, and I think fundamentally we need to see that U.S. market has particular risk factor on high interest rate. To be honest, the ROE expectation for most of the companies has been adjusting down, but those 7 companies are adjusting up because of the theme, which is the AI theme. So I think this is a little bit tricky to justify, but I think this is representing a view for the current market. The U.S. stock is probably have some risk factors, so you do need to consider, especially for current environments. If you move down, next page, please. So this is showing that we're probably facing a correction due to high valuation, because currently the S&P looks a little bit expensive, and so is Nasdaq. Why is it expensive? Because high interest rate, strong dollar. The dollar is a flow back to the U.S. market, so U.S. becomes no matter it's equity or fixed income, that becomes more attractive. But on another side, so they are diverging from their fundamentals. I think from most of the investors we have been discussing, no matter it's offshore investor, onshore investor, or institution, they do believe that current stage, if they want to add more positions to U.S. equity, then that's not going to be possible. But if we consider de-risking a little bit, so that they think that's the right time to do some like position cuts. Because for next year, you never know whether your valuation correction gonna come in first or the rate cut's gonna come in first. So you need to take evaluate your performance and evaluate your portfolio and see do I have enough performance for the whole year? If so, I would suggest that just avoid this kind of scenario, because recent rally already a year-end gift. If you want to take more, then you will take like Q1 risk. If the economy facing real recession, then what happens for the stock market? Then that's a very simple thing. You're gonna facing a correction in valuation and revising your expectation for the earnings. So just give you a little bit direct view. If you move to the next page. This is valuation percentile, or you call it standard deviation way. So you can see on left-hand side. So that's the extreme value. And for the left, I think this is for the can't see clearly. So this is just simply saying that the valuation percentile is a very extreme, right, at current stage, and forecast PE, and no matter it's a forecast PE or it's a risk premium side. What does it mean for the risk premium is whether you can be compensated by investing risky asset like equity, get compensated by risk premium. So risk premium is so low, which means it's not worth to take the risk. It's simple as that, which is shown on the right-hand side. But on your left-hand side, I think this is the valuation as average, like PE, and I think that's just give you an idea how is it deviating from normal. So the baseline is red. So currently we are one standard deviation away, something like that. For the forecasting PE, we already priced in the projected earnings. So which means it's not based on historical. If the earning can be adjusting down, if what happens for next year need to be adjusting down, then which means our valuation will becomes even higher compared with the current graph. Yeah, for the last next page, please. For the last graph, I think we are talking about the U.S. Treasury bonds. So this is what I mentioned. This is a ticking up point, which means the yield is quieting down. But I think that's mainly due to the October end Treasury adjustment. So it's not normal. because as I described from August to October, so they realized that the market cannot hold the large amount of issuing. So they're adjusting their Q4 issuing and cut it down. But as I mentioned, so how much you need to spend as a country or as an economy, that's a kind of fixed, and you're probably expecting they spend more and taking more leverage. So I don't think that the current cutting issuing is not, I don't think that's going to be sustainable. So they're going to resume issuing more debt. And during probably in the coming year. So if that really happening, and which means the mirror situation going to happen again, say from August to October. So you're going to have a more issue and longer rates are probably shooting up. But by the point of time, Q1, no one actually expecting cutting rates. If the cutting rate expectation is not coming, then you will have a supply and demand problem. Unless we have a, say, recession and all the money has been pushed to the risk-free assets. Otherwise, I think the bond market is probably gonna have a very big challenge in next year Q1. Yeah, that's my view for the US market, I think.
Thank you so much for that, Yiwang. Now you've covered just a really comprehensive range of also concerns for next year. I think we have a lot of questions coming in. So again, to everyone, we do not have a live Q&A today, but we will be collating your questions. And if we pick those questions for CSOP Asset Management, then you will receive some rewards from us, okay? So right now, if you're ready for quiz 1, Yiwang, we will be back with you shortly for more questions. But if you're ready for quiz 1, give me a thumbs up and a big yes, everyone, in the chat box right now. Are you ready for quiz 1, everyone? I want to see some engagement and energy right now for our show today. Okay, and let's show the question. Once again, you've got to get it right, and fastest fingers first, and go. The federal funds target rate upper bound is as of November 1st, 2023. What is the correct answer? Is it A, B, or C? A, B, or C? We have a lot of comments. Okay, last 3 seconds. In 3, 2, 1. Okay, the correct answer is it's C, everyone. Congratulations to those who got it right. Let's give everybody a thumbs up in the chat box, everyone. Great job with that. That was the first quiz for today, and we'll have 2 more upcoming soon, okay? I still have people giving me a lot of thumbs up. So yes, Yiwang, we've got great energy in the chat box right now, but we'll be back with you shortly, okay? Because we're about to show them how they can access the funds for themselves. So everyone, show your phone here. I've got the phone. I've got your messages coming in. I want you to follow through with me on how you can access this, okay? I know a lot of you are already pretty well versed with the tools that you have on here. But for those who are new, especially the new investors coming in, I'm going to show you how you can easily access this fund, okay, and apply what you just learned. So if you go to your watch list, you open your account. It looks like this. You go to Discover, go to Funds. Very easy. This one, you just have to go to Cash Plus, okay? So under Cash Plus, you can see, of course, just now we had the first, and then now we're going to try for CSOP USD Money Market Fund. And you can see over here the performance, the yield, the historical returns, and of course, the position details. Now, everything is here detailed just for you, okay? So it's all at your fingertips. It's everything you need to know, and it's updated in real time as well. If there's any updates, the teams are onto it as soon as possible. And usually I would adjust the time frame depending on what I'm looking at, right? So if you are looking at, you know, a 7-day yield on this graph here, you can also adjust according to the time frame that you're looking at, from macro or even just, you know, something more recent. So everything is here. You go to comments, you can see what everyone's saying about it, and of course news to keep track of all the latest buzz related to the topic. So over here, it's not necessarily just about the fund, but it's also anything that could be related to the topic of discussion. So I think this is great because you can also filter according to dates and the time frame that you're looking at. So it really depends on you guys. If you have any personal choices, everything is here for you to analyze for yourself. Okay, here under analysis, you can also review the AUM and also the regions, credit ratings, maturity, bond type, everything is listed here. And of course, summary, which is super important for yourselves if you want to have access to the fund documents. So over here, you got the fact sheet of everything you need to know, all the details. Again, you just have to go to summary, and under fund documents, you can see the updated fact sheet and also annual reports right here. If you're ready to heart it, give it a big heart over here to put it onto your list. And of course, if you're ready to subscribe to it, you go down to the bottom and you can see the big orange button right here on the bottom left-hand corner if you're ready to subscribe to it. Okay, so if you have any questions about this particular fund, definitely drop us an email. Again, at the end, I always promise you the emails that we're going to drop for you guys to contact our product teams or even our client service team. Okay, and the replay of this, go to Moo, and you can see it right here. So of course, I'm giving you guys hearts right here and tracking your comments, but definitely if you like content like this, do follow us right here. You can go to Moo Rich to see all the latest details, right? Give it a follow right there and you can be on top of all the live shows that we have for you. We have the replays up on here and also previous live shows that you've missed, right? We have so much content for you. And of course, give us a follow on our social media pages if you need any more side activities for yourselves and to see what other topics you want to see. Drop us a message as always. So we hope you enjoyed that. And right now we're going to invite Yiwang back onto the floor because I've got a few more questions for him before we round up our discussion. Now, Yiwang, my next question for you will be, related to NASDAQ, for example. So the outlook right now on US equity, and this is also a hot topic amongst our audience members. For example, how would NASDAQ perform in 2024 as an outlook from CSOP's perspective?
Yeah, it's a very hard question, to be honest. Personally, I think it's at point of time now, it's very tricky to confirm whether the theme going to be further sustainable, because we are already priced in a lot of expectations for the theme for the AI. So within US, I need to confess that we have seen a lot of showcase and real implementations of the theme, which is a good news. But on the other side, can they really realize the expectations of the stock valuations? So that's a little bit tricky because we give too much credit or too much expectations for the current level. But that's I think that's a good thing, or the interesting part of the market, because you never know what's going to happen. And but from my view is relative basis, if you compare to rest of the world, other markets, I would say US or NASDAQ may not be the most say attractive market right now if you want to position yourself for next year. Probably they just jump up 50% next year. I don't know, but that's the magic of the say the tech companies. Because we have been through this kind of story again and again and again, so we have like for this run it's AI theme previously, so metaverse and so forth, VR, AR, they could be, and probably very hot right now, but they can be realized several years later. So it could be the case as well. So my view is you need to understand that currently the risk is there, and they are not cheap. And you are betting further on not cheap like stocks, then you need to take a bit risk over there. And also for the run of the recent months, I think that's only reflect, say, from macro side, there's no particular black swan events or pressures from macro, from interest rate, from bonds. Then I just added some positions on equities. But the tricky thing is, what if they come back again? Then it's just erase whatever has been rallied so far and then come back to normal. Then that's very easy to happen. Yeah.
Thank you so much for that. So the next question then, we're looking into China's equity space for 2024. We definitely have to talk about that because we're already getting questions on that. So what is your take on that?
2024, I think if we move to the presentation, I think the first page, or 14, page 14. We heard a lot of news, yeah, as a matter of no matter is regarding China property or the debt deleveraging and US and China relationship and so forth. It's towards the better angle, to be honest. But sentiment-wise, onshore or Hong Kong, I think is still very low. We enter into a kind of a tricky area, like investors losing confidence during last 2 or 3 years. If you're talking about like losing money for 3 years, then you won't give too much like confidence to the market, right? And so it's getting better from whole environment perspective, but on the other side, we do need to understand that the property problem or deleveraging problem that's ongoing for long term. So because the size and also the impact to the whole economy. So that's the reason why a lot of headline news talking about that. So if we move to next page, please. So 3 factors I think we need to discuss. For example, monetary environment. So this is very important, I think. There are currently a lot of expectations cutting rates for the onshore economy, and which is a surprise, I would say. We didn't see too much movement on that. It could have 2 kind of impact if they really cutting rates. One side is the deleveraging will be easier because you're going to refinance yourself with a little bit lower rate. And another side will boost up the liquidity. Because right now we do see some liquidity problem. That's linked to the credit as well. So we see a shrinking credit onshore. If you're lowering rates, then lowering the burden, and which is better news for the private sector and also the corporate side. Fundamentals, I think a lot of people talk about that, so it's not that bad, to be honest. A lot of companies, if you look at balance sheet, they are good and they are still making money. Just in terms of growth rate, it's not dramatic as before. But if you're talking about they're gonna bankrupt, or they're gonna facing a lot of problem. If I'm not talking about the real estate sector, right? For other things, I think it's still okay. But lastly, the third one, I think that's the most concerned problem right now, because we, as an economy, China currently interest rate spread compared with US one is relatively big. So we're under pressure of depreciation, and also the export-import figure is not looking very pleasant. So that's the reason why we see a quite strong depreciation pressure coming during the year. Fortunately, right now, I think it's stabilizing a little bit. One side of the reason is because the US longer end has been smashing down, so the spread is relatively tightening. But again, we need to see a concrete a support of the interest FX. So why FX is very important? If we move to next page. Because historically, every single time we have a booming market, which means we have a very strong currency. That's nearly no exception about that. If we think about the logic, that if RMB or the local economy is very strong, which means we have a strong demand, we have a strong corporate profitabilities. So which means we're gonna have a relatively strong equity market. They can make more money. Take simple equation in Hong Kong market, I would say if you are listed Chinese company and your profit or your turnover is all denominated in CNH or CNY, then which means any appreciation regarding your revenue, then you're gonna revalue yourself based on Hong Kong D denominated shares. So the equation is very simple. So if you're appreciating your revenue currency, then which means your stock price can be lifted up. So it's very straightforward, I would say. So I would say for outside words, if we move to page, I'd say this is page 19. So this is page 19. If we move to so this is regarding the global managers view. So how would they invest in emerging markets? Previously, we see some hesitations around the global managers. They pick up the position again. So which means right now they do need to consider how to position themselves for next year, and whether emerging market is a choice again, because we're talking about cutting rates. If the risk normalized, then they will seek returns. A lot of economies like India, Vietnam, that's a hot topic around the global investors right now. And China, yeah, we talked to some of the China onshore investors as well. So they do believe that they enter into a kind of bottom. The thing is, the argument they're holding is we got nothing to lose at the current point of time. Now the market is showing that extremely low turnover and extremely low, can't say extreme, but relatively low valuation. And also there's a lot of problems. If a good news coming out, then nothing really happens to the major markets. Then it's a kind of no one really interested around the market. So this is kind of a phenomenon. They judge that now we are standing at the bottom of the Asia or the Hong Kong shares. That anything gonna happen is not gonna be worse than now. So I think the argument being taken, and we do see some interest from outside, global investors would like to see their positions within Asia and within Hong Kong. But I think the fair question is to test whether China be attractive or the Hong Kong shares be attractive or not. The only condition is you're gonna have when you have a decent rally, whether the flow gonna coming back. If the flow is not coming back, then you can prove that you are not very attractive. But now you're talking about China or Hong Kong shares is not attractive at all. Yeah, the simple story is if you're talking about the market losing money for 3 years, probably the manager got fired already. So they can't make any comments to say, okay, I'm not interested in China markets or Hong Kong market, right? So once the market start to perform or start to rally, then that's a time we discuss, say whether okay, those investors gonna coming back to the market or not. Yeah, probably for page 21. We skip it a bit. Yeah. So this report is showing that for the emerging markets allocations, one is for overseas managers. They are they allocating the global equity. They underweight the equity. They see the scary or they see the risk for the whole year. For a lot of managers, they are not beating the benchmark, to be honest. Yeah, so they slightly deviating from the benchmark by holding more cash from their portfolio. But interesting thing, I think, is non-US manager, they seem more balanced. So if they see opportunities, then they will add positions back, no matter it's China or EM or whatever. But US seems extremely biased. So they're gonna underweight a lot, and especially for EM and China. So yeah, again, so as I mentioned, once the stock coming back, once the performance coming back, then we're gonna see what gonna happen for the allocations. Next page, please. This is showing that the sentiment already completely shifts or showing some patterns, because for beginning of the year, we see that Asia is attracting a lot of flows. I think it was around 200 billion something in RMB terms. But point of time now, I think already dropped to 50 billion something around that level. But for Hong Kong shares or Hong Kong, say, outstanding units being increased quite a lot, even though those both market is not performing. But I think Hong Kong is relatively attractive, and a lot of money flows from southbound to buy Hong Kong equities, especially for Hong Kong tech, Hang Seng Tech. So this is showing a pattern. I think they firstly they do believe that there's more chance or rally in terms of potential. Hong Kong, if we talk about rally, then they probably rally more. But for Asia's, they probably could diversify their currency exposures by entering into the Hong Kong market. We can explain a little bit for the whole year, like flow patterns, by judging, say that. Yeah, for next page, please. I think for the industry, there's for China, I think we do need to admit that there's kind of a slowing down. So no matter is from the growth absolute level or the relativity level, but they are still trying to boost up, no matter from regulatory perspective or the corporate performance perspective. They urge the company to pay dividends, and also the say China those tech names and buying back their shares, which has been buying for a very long time. Yeah, I think they are building up this kind of like resistance level, and hopefully that can achieve better results if the liquidity from US say cutting rates really happens. Then what happens is for liquidity is spreading out to the emerging markets, then all the market can be benefited from the lower rates as possible for next year. But I think, as I mentioned for previous session, that's going to be a little bit tough. Probably not that easy to come in very soon, I'd say. Yeah, probably that's my view for the China and Hong Kong. And yeah, I know there's going to be a lot of questions.
Yes, we have a lot of questions on this for extender questions, but thank you for that comprehensive overview for China equity in 2024. Now, before I ask the last questions and we round up today's live show, I know everyone's ready for quiz 2. So for quiz 2, remember, fastest fingers first, okay? This is going to be really fast. So I want you to be ready for quiz 2 right now in 3, 2, 1. The US 10-year yield is than Singapore's 10-year yield now. Is it higher or is it lower? A or B? A or B? Let's go. Let's go. 5 more seconds and we'll choose the winners. And we have our winners. Congratulations to everyone who participated. You guys are quick. Yes, the next one, the last giveaway is going to be really fast as well, okay? So be prepared. Be prepared. So if you think you won this, give us a thumbs up if you think you got it. The correct answer is A, higher. So congratulations. Now, last question for you, Yiwang. Japan is performing well this year. So will the momentum continue for 2024? What is the outlook for that?
Yeah, Japan, I think is for October, they're slowing down for GDP perspective. But my view on Japan is as far as the inflation continue and the corporate can make money and they can afford the increase of salary and make the inflation momentum going, then you will expect a better perform like Japanese equity markets. But bear in mind how much they rally. Probably we are talking about how much depreciate on yen. So just be careful about your Japan allocations. So that's something I think they need to do. Not necessarily shutting down the YCC immediately because you need the momentum. Because they implement the extreme monetary policy for 10 years. And all of a sudden, inflation coming back, you are talking about hiking rates and remove YCC to fight against inflation or boost your currency. I don't think that makes sense. But even though the market is talking about this kind of topic for a while, recently, I think. So if they still hold YCC unchanged, and no pressure on the inflation, then I think the trend could continue. Yeah.
Thank you so much, Yiwang, for that. So we covered for the second half, US equity, for example, for NASDAQ, how it will perform for 2024. We covered China, and then we really rounded it up with the Japanese side of things, okay? So thank you for covering all these different sectors for us. If you have more questions, remember that we're looking out for those questions. And if you get picked, you'll be rewarded after the live. And also the replay will be made available immediately after this. Now, before we go into final takeaway, here is quiz 3 for everyone. If you're ready for it, give us a thumbs up or a heart in the chat box right now if you're ready for quiz number 3, everyone. Again, while we're waiting for people to give us a thumbs up, remember, fastest fingers first, and you've got to get it right, okay? You've got to get the question right. And let's go. The question is, CSOP USD money market funds 7-day yield shown on Moomoo is A, gross of fees, or B, net of fees yield. We got a mix of answers here. Is it A or is it B? A or B? You better double check, everyone. Okay. Last 3 seconds. Last 3 seconds. A or B? And we have our winners. So congratulations to everyone. The correct answer is B. Congratulations. Okay, so Yiwang, with that on the topic of investing in 2024, are we truly at a turning point? What is that final takeaway for everyone today?
Yeah, I would say this year it has been very exciting about the most popular trade field, like US recession and China recovery. Then we enter into a stage like we seem to come back to last year again. See, we are heading to a lot of arguments say, oh, US heading to recession and China gonna recover because it's already bottom of the bottom. We suffer another year. So for next year, seriously, I would say it's possible it's coming, but just do not all in. So US will probably have some corrections happening for given valuations for current for current valuations and for current like interest rate and debt issuing patterns. So we already share our views with the audience. For China, to be fair, there's a lot of things they can do, but we don't see any has been implemented. For example, fiscal policy spend a lot of money or lower the monetary policy rate to reduce the burden. That entirely depends on next year how they plan themselves for in terms of economic outlook or economic growth expectations. If they don't set particular targets, then which means okay, another year to wait because they have a heavy burden of say deleveraging need to do to reduce the debt level. But if they do something, probably that's going to be something big. And especially for China and the US, I think next year is going to be very tricky for the election and everything going on. So don't be too aggressive. That's my suggestion. Yeah. Thank you.
Thank you. And that was Head of Quantitative Investment, everyone from CSOP Asset Management, Yiwang. We'll see you next year for our next round of shows. And Happy New Year. We'll see you next time. Thank you for being on here.
Yeah, thank you. Thanks for inviting. Happy New Year as well. Yeah. And Merry Christmas.
Of course, and happy holidays. So to everyone watching, we're in the final few weeks of the year. We came up with this series for you so that you can start to look for alternatives or potential strategies that you can use for yourselves in your current portfolio. As usual, this series is really a bridge to experts like Yiwang today. So we really hope you enjoyed that. Really love the engagement on the show. And of course, we'll take the questions and follow up from there if it gets chosen, okay, for CSOP Asset Management. So if you want to see more shows like this, do follow our page right here. I showed you how to follow it, but this is where you can get the updates on the funds and also the replay of this. And if you do want to submit any questions or topics of discussion you want to see next, if you want to see a particular speaker, you can also follow me on this page right here in app, and I will monitor and see what you would like to see next. And of course, our social media channels right here. We're really active on everything. And if you really want to be in the know of what's upcoming, follow these pages and you'll find out what's next, okay? And of course, the email from our teams. If you want to contact anyone on any follow-up questions related to the product, drop us an email right here. The teams will be in touch, okay? And of course, next time we'll see you for the next round of series. That will be next year. But for this series, this was the last show for the 3-day part series of our Moomoo Investment Outlook for 2024. If you want to watch the replay, they're all online on our YouTube channel and also in-app. So do check it out and learn for yourselves. So thank you everyone for being here with us. We'll see you for the next show. Once again, I'm Olivia Higgins and happy investing.
Okay, thank you.